You have likely been trained to celebrate a zero-balance lifestyle. The conventional wisdom says that hoarding cash and cutting up your credit cards is the safest path to financial security. But leaving your capital locked away in a static account guarantees it will be quietly eaten alive by inflation. When you look at the balance sheets of the global elite, you see a completely different set of rules. They do not run away from debt or view it as a catastrophic risk. Instead, they use it as a highly calibrated weapon to acquire assets that produce consistent, reliable cash flow. This chart compares two methods of acquiring real estate. On the left, the retail method, saving cash for decades to buy a property outright. On the right, the elite method. You deploy a fraction of your own cash, exactly 20%, to secure the asset, and you let an institutional mortgage fund the remaining 80% of the transaction immediately. Once that property is secured, you install a qualified tenant. Their monthly rent completely services your debt, pays for the local taxes and maintenance, and leaves you with a net cash surplus. While you go about your life, the tenant actively pays down your principal balance, and macroeconomic inflation drives the nominal value of the property up. In 10 years, a $40,000 initial cash outlay has captured the compounding appreciation of a $300,000 asset. You did not trade finite hours for that equity. You manipulated the exact mechanics of the banking system to manufacture it for you. But creating that equity introduces a new structural problem. Once value is built inside a primary residence, it sits completely unproductive behind a wall of brick and mortar. Many view this trapped value as a psychological safety net. In reality, debt equity is a massive opportunity cost. Every single day that your capital sits idle in a physical structure, it is bleeding your potential net worth by doing absolutely nothing to generate new income. To extract trapped capital without selling the property, operators secure a home equity line of credit, or a HELOC. This revolving credit line is backed directly by your home's value, giving you access to liquid cash at dramatically lower interest rates. There is a strict operational guardrail here. If you use this credit line to fund non-productive lifestyle debts whose monthly cash yield comfortably exceeds the interest rate of the credit line itself, sophisticated operators refuse to let their capital stagnate in idle safety nets. They construct systems that guarantee every single dollar is in perpetual productive motion. The biggest barrier for aspiring entrepreneurs is a timeline issue. They assume they must grind out a linear salary for years to save a massive initial down payment before they can ever launch an enterprise. The banking system cares about the reliability of cash flow, not the size of the asset. You can utilize specialized commercial microloans to acquire physical assets on day one, like a route of premium automated vending machines in high-traffic commercial zones. It covers its own restocking, the ongoing maintenance, the monthly debt service, and yields pure passive cash flow. This chart illustrates how active businesses manage cash flow volatility. Suppliers demand payment today, but enterprise clients pay on 60-day terms. To smooth out this volatility, you establish a revolving business line of credit. It is an open financial reservoir that charges zero interest until you actively draw upon it. When a volume discount appears, you draw the cash, capture the profit margin, and instantly pay down the balance. This applies to elite freelance operators too. By using targeted equipment financing to acquire a cinema-grade camera or an advanced computing workstation, a contractor can double their weekly production output and capture premium client billings without draining their personal savings. In commercial operations, strategic debt operates as a literal time machine. It eliminates the traditional multi-year capitalization phase and allows you to capture market share immediately. Now we look at how debt behaves depending on who holds it. An average consumer signs a high-interest personal loan for a luxury vehicle. The car loses value the second it touches the asphalt, draining monthly disposable income. But if an operator structures that exact same acquisition through a corporate entity, selecting a heavyweight commercial vehicle deployed for logistics, the entire purchase price can frequently be written off against corporate revenue under advanced tax codes like Section 179. A depreciating liability becomes a tax shield. If you made mistakes early on and are currently stuck carrying high-interest consumer credit cards at 25%, you are trapped in a cycle where minimum payments only cover the interest. To break this, you deploy a strategic interest rate swap. By using a low-interest institutional loan or consolidation framework, you completely liquidate the high-interest balances. You rewrite the physics of the debt from a 28% variable rate down to a 7% fixed rate, allowing every dollar to aggressively attack the principal. Securing those premium terms requires a pristine credit score. This metric is not a passive grade on how much money you have saved. It is your literal financial reputation across the global banking ecosystem. It explicitly dictates your capital efficiency and your ability to borrow at rock-bottom rates. The modern tax code and banking architecture are explicitly designed to reward those who operate through corporate entities, and they actively penalize the linear earner. As your net worth scales, the ultimate retail mistake is selling your core assets. When the average person needs liquid cash, they sell their stock portfolios. The moment they click sell, they trigger a catastrophic tax event, destroying 20 to 30% of their accumulated wealth in a single transaction. This diagram illustrates the buy, borrow, die framework. Instead of selling off their holdings, the ultra-wealthy secure a securities-backed line of credit. They pledge their multi-million-dollar equity portfolios as collateral, and the banking institution grants them a massive revolving line of credit at prime institutional rates. The core loophole here is incredibly simple. The IRS does not legally classify loan proceeds as taxable income. The operator receives millions in cash without triggering capital gains tax. Because the underlying stock portfolio remains completely intact, it continues to compound and pay dividends in the background. Those dividends automatically service the new low-interest line of credit. You have completely decoupled your access to liquidity from your tax liability. You now see the exact blueprint, but do not misunderstand the mechanics. Debt without flawless operational management, meticulous tracking, and absolute emotional discipline is a highly dangerous financial execution weapon. If you lack the discipline to manage your cash flow pipelines, this leverage will crush you. The system does not pause for anyone, and the elite are already deploying these structures to capture market share. Subscribe to the Money Formula right now, and tell us in the comments which exact framework you are going to deploy first to escape the linear income trap. We will see you in the next briefing.